A lot of folks have interest in that option, and in part because they look at the full 180 month term and they say, well, guess what? It's going to be less than half the interest as a 30-year loan, and I'm not paying more than double my loan amount in interest with that option. Sure, that's true. But the trade-off is, can you comfortably handle $1,000 a month more in your principal and interest payment? Even if you're able to qualify for that $1,000 a month more payment, which in many cases that borrower who's inquiring about a 15-year loan, and we find out, well, they can't really afford it based on debt ratio anyway. But even if they can, a lot of times they say, well, wait a minute, I don't want to pay that much more. And what that really means is they don't want to be locked into paying that much more month in and month out. So sometimes the reply is, well, I'll stick with the 30-year, but I'll pay some extra on my own in order to reduce the interest cost. And yeah, that is an option. Or the other thing that folks will look at doing is, well, I'll go with the 30-year loan and then set up a biweekly payment and be able to pay less interest that way, which is an option, but I don't think is the best option. And the reason I say that is because of, on the bottom here, the last one, 20-year loan. Now look at this. A 20-year loan gives you a substantial benefit in rate over a 30-year, just like the 15-year loan does. 5.25%, not quite as good as a 15-year, but really very, very, very close. 5.25%, 20-year fixed. Your monthly payment is going to be higher than the 30-year loan. Yes, $33.68. That's a lot more reasonable, a lot more manageable than that 15-year payment. And so when you consider that and the fact that, yes, you're going to pay a lot less interest over the 20-year term, $309,000, again, still a little bit more than half your loan amount, but certainly not double your loan amount, that becomes something that you go, wow, hadn't really thought of that. Hadn't really heard about that very much.